Good morning, sir. I'm Guan Yuwen, and my entry number is 287576. So I will start our presentation with introduction part. First, our team has analyzed the financial statement of two companies chosen, which are Oriental Holding Berhad and OCB Berhad. First, financial ratio is a useful tool for evaluating a company's financial position and operation against other organizations. Next, liquidity ratios used to determine a company's ability to pay bills or debit when they are due and to meet unexpected needs for cash. Next, activity ratio is used to measure how efficiently a company uses its asset to generate revenue and maximize profit. Fourth, profitability ratios is used to indicate how well a company utilizes its asset to generate profit and value for shareholders. The last one is leverage ratios, used to determine the relative level of debit loan that a business has incurred. Next, I will talk about the profile and main business activity of two companies that we chosen, which are Oriental Holding Berhad and OCB Berhad. The first one is Oriental Holding Berhad. Oriental Holding Berhad involved in investment holding and provision of management services. Oriental Holding Berhad is a diversified group comprising 71 subsidiaries and 13 associated companies with business activity in the countries such as Malaysia, Singapore, Thailand, Indonesia, Brunei, Vietnam, New Zealand, Australia, United Kingdom, Mauritius, and People's Republic of China. Business activity of Oriental Holding Berhad covers 7 core segments such as automotive and related products, plastic products, hotel and resort, plantation, investment holding, investment property and trading of building material products, and healthcare. The next one is OCB Berhad. OCB Berhad is an investment holding company based in Malaysia, and OCB Berhad involved in a variety of segments such as building material, bedding products, and consumer foods.
The current ratio is a liquidity ratio that evaluates a company's ability to pay short-term commitments within a year. It demonstrates to investors and analysts how current assets on a company's balance sheet might be maximized to pay down current debt and other payables. Furthermore, because short-term assets value exceeds short-term liabilities, the higher the current ratio, the better an organization's ability to repay its debts. According to the report, OCB Berhad's current ratio is 1.901, meaning that the company has RM1.90 in current assets to pay its liabilities for every RM1 in current commitments. The current ratio of Oriental Holdings Berhad is 2.341, suggesting that the company has RM2.34 in current assets to cover RM1 in current liabilities. The current ratio indicates that OCB Berhad has a low efficiency in paying off its commitments, with the firm gaining 1.90 times, indicating that the company is in poor financial shape. On the other hand, Oriental Holdings Berhad has a current ratio of 2.34, showing that the firm properly handles its commitments. As a result, Oriental Holdings Berhad has a greater capacity to meet its obligations and liabilities than OCB Berhad due to its larger current ratio of 2.341 against 1.901. Oriental Holdings Berhad, on the other hand, has an abnormally high current ratio, far above 2, indicating that the company is not successfully utilizing its current assets or short-term financing commitments. This might potentially indicate a problem with working capital management. The quick ratio, commonly known as the acid-test ratio, indicates a company's or organization's ability to pay immediate responsibilities. The notion of a quick ratio has emerged as a result of the fact that inventory liquidation cannot be completed promptly. The quick ratio guarantees that the company's liquid assets are sufficient to meet its short-term obligations. The numerator includes quick assets such as cash, short-term marketable securities, and accounts receivable, while the denominator includes current liabilities. Because inventory is excluded from current assets, the quick ratio is more conservative than the current ratio, which is a more well-known liquidity metric. Inventory is removed because some firms have difficulty converting their inventory to cash. If short-term obligation must be paid off soon, the current ratio may overestimate the company's short-term financial health. The quick ratio assesses a company's capacity to satisfy short-term obligation see using its liquid assets. The higher a company's quick ratio, the better its liquidity and financial health. Then, the lower the quick ratio, the more likely it will have difficulties paying its debts.
Good day everyone, my name is Vaidishwari Lachmanan and my matrix number is 288072. Today I'm going to talk about activity ratios. An activity ratio is a sort of financial indicator that shows how effectively a firm is generating revenue and cash from its balance sheet assets. Activity ratios are especially effective when comparing two competitive firms in the same industry to see how one company compares to its rivals. Definition of inventory turnover. Inventory turnover is a financial statistic that shows how many times a company's inventory is sold and replaced within a certain period. Definition of total asset turnover. The asset turnover ratio compares the value of a company's assets to the value of its sales or revenues. The asset turnover ratio is a metric that measures how well a corporation uses its asset to produce income. Definition of accounts receivable turnover. The receivables turnover ratio is an accounting metric that determines how efficient the firm is at collecting its accounts receivable, or money owed by customers or clients. This metric assesses how successful a firm manages and uses the credit it gives to consumers, as well as how fast that debt is recovered or paid. Formula to calculate activity ratios. Number 1. The formula to calculate inventory turnover is cost of goods sold divided by average inventory. Second, the formula to calculate total asset turnover is net sales divided by average total of assets. And third, accounts receivable turnover is calculated by dividing net sales with average trade receivable. Inventory turnover. The inventory turnover for two firms, Oriental Holdings Berhad and OCB Berhad, is shown in the table above. The inventory turnover of Oriental Holding Berhad is 10.10, which is higher than that of OCB Berhad, which is 7.08. Inventory turnover for Oriental Holdings Berhad is 10.10. This means that inventory is on hand for 36.14 days. Asset turnover. Total asset turnover for two firms, Oriental Holdings Berhad and OCB Berhad, is shown on the table above. The total asset turnover of Oriental Holdings Berhad is 0.33, which is lower than OCB Berhad, which is 0.99. OCB Berhad produced Rm 0.99 in sales for every Rm in assets, whereas Oriental Holdings Berhad generated Rm 0.33. Accounts receivable turnover. The account receivable turnover for two firms, Oriental Holdings Berhad and OCB Berhad, is shown in the table above. The account receivable turnover of Oriental Holdings Berhad is 8.65, which means that Oriental Holdings Berhad collected their receivable 8.65 times on average that year. That's all from me. Thank you.
Profitability ratios are a popular technique in financial ratio analysis. They are used to calculate the company's bottom line for its management and its return on equity for its investors. Profitability ratios are classified into two types, which is margin ratios and return ratios. Most profitability ratios imply that the firm is doing well if the value is higher than a competitor's ratio or the same ratio from a prior quarter. In a basic profitability ratio research, the profit margin on sales is the most typically used margin ratio. The profit margin on sales shows how much of each sales RM remains as a net income after all expenses are paid. For example, if the net profit margin is 7%, it means that 7 cents of every RM in sales is profit. After the calculation, we can see that the profit margin on sales for Oriental Holding Berhad is higher than OCB Berhad, which is 2.1% and 0.94%. Return on assets is used to measure how well a firm uses its asset to create profit. The greater the return on assets, the better, because the firm can generate more money with less money invested. Simply said, a higher return on assets indicates greater asset efficiency. Regarding to the calculation, we can see that the return on assets for Oriental Holding Berhad is higher than OCB Berhad, which is 0.94% and 0.93%. This means that the company with a lower ROA indicates there is a room for improvement.
Assalamualaikum warahmatullahi wabarakatuh. To my lecturer Sir Azlan bin Saida Abidin, and hi to everyone. My name is Muhammad Muzaffar Shah bin Cik Masri. My metric number is 287117. For leverage ratio. Leverage ratio is one of several financial indicators that assess a company's ability to meet its financial obligation by looking at how much money comes from debt. This is for Oriental Holding Berhad for year 2020. This is for OCB Berhad for year 2020. This data we take from annual report year 2020 for two companies. Debt to asset ratio. The debt to asset ratio is a leverage ratio that indicates how much of an asset value is financed by debt. The higher of debt to income ratio will the greatest to financial risk. This is the formula debt to asset ratio. For interpretation debt to asset ratio between two companies, Oriental Holding Berhad has a debt to asset ratio of 26.4% in 2020, which is lower than OCB Berhad debt to asset ratio of 31.7%. In comparison to Oriental Holding Berhad, it appears that OCB Berhad has been more active in funding its expansion with debt in 2020. Profitability may be unpredictable as a result of the greatest interest expense. Debt to equity ratio. The debt to equity ratio measures a company's financial leverage by dividing its total liability by its shareholder equity. The debt to equity ratio is an important metric in corporate finance. It's a measure of how much a company's activities are supported by debt rather than fully owned capital. This is formula for debt to equity ratio. For interpretation debt to equity ratio between two companies, Oriental Holding Berhad has a debt to equity ratio of 35.9% in 2020, which is lower than OCB Berhad debt to equity ratio of 56.5%. A higher debt to equity ratio is commonly associated with high risk since it suggests that a company has utilized debt to fund its expansion. In comparison to Oriental Holding Berhad, this suggests that OCB Berhad has been more active in funding its expansion with debt in 2020.
Lastly, we can make a conclusion based on the calculation of ratio. For liquidity, Oriental Holding Berhad shows a satisfactory ability to meet its short-term obligation and able to pay off its liability, but OCB Berhad has a low efficiency to pay off its short-term liability. For activity or efficiency, Oriental Holding Berhad has a higher inventory turnover ratio compared to OCB Berhad. This shows that OCB Berhad may be facing overstocking. For profitability, OCB Berhad obtains a lower profit margin on sale ratio and return on asset ratio compared to Oriental Holding Berhad. The last one is leverage or solvency. Oriental Holding Berhad has a lower debit to asset ratio, implying a lower financial risk than OCB Berhad. Also, OCB Berhad with higher debit to equity ratio has less financing and debt service cost compared to Oriental Holding Berhad with lower debit to equity ratio. That's all from us. Thank you.